or without. Come interest means interest is included. Ex interest means it is not included. Now suppose you buy 20 government bonds of rupees 1,000 each. It is its face value. Face value on October 1st, 2011 at rupees 960 per bond. Come interest. If they are come interest means interest is included in it. Normally the interest is paid on on 30th June or 31st December. That of each half yearly interest is paid on securities, 30th June and 31st December. We are buying on 1st October. It means the last interest had been paid on 30th June. From 30th June to 1st October, how many months come? 3 months. July, August, September. Because company is paying interest on 1st October. So it is 3 months interest. So therefore, when we will buy this 20 government bond, 10% government bonds. So how much we will be paying for that? 20 into 960, 19,200. Now accrued interest. Accrued interest. How much it would be? We have bought 20 government bond. Each government bond is 1,000. What is the face value of the government bond? 20. Interest is always calculated on face value. Rate is 10% and period was coming 3 months. Accrued. That is from 30th June to 1st October. In that we are coming 3 months, July, August, September. How much it comes? Interest comes to 500. Now we have paid 19,200 for securities. And we have bought come interest. This including interest. So how much we have paid for securities? 19,700. So what entry we will pass? 20% government bonds account debit. How much we have paid for government bonds? 19,700. Accrued interest. 500. So 2 bank, 18,700. 2 bank, 19,200. So what we will write? Purchase of 20 government bonds. 10% government bonds. Come interest. That on 31st December, we will get complete 1,000 interest from the government because we have bought come interest with interest. The seller will not receive the interest. We will receive the interest. If in the same way we have bought X interest, it means the next interest, falling interest, will be received by the seller. Further, it will be received by us, but the next interest on 31st December will be received by the seller. The total cost of the bond is 20 into 960, 19,200. Accrued interest is 500. The total we are paying 19,200. Out of that, and will be losing X interest. We will not getting interest. We are losing 500 for interest also. The total it would be 19,700. So here the government bond would be 10% government bond, $19,700. 2 bank, 19,200. 2 accrued interest, 500. Now this is the difference if we buy X interest and we buy come interest. If we are buying come interest, what was the value of the government bonds? 18,700. Accrued interest 500, to bank 19,200. When we are buying X interest, that the falling interest we are not receiving. Falling interest will be received by the seller. In that case, we are with 19,200, 700, we are also losing interest of 500. So that is 19,700 plus 500 we are losing for interest. So actual bonds would be to us 19,700. In business, investments are shown on the asset side and bond debentures are shown on the liability side. So if we have any investments, we will show on the asset side. If any liabilities, we have shown on the liability side. But interest, if we receive interest, it is our income. But if we pay interest, it is our expenditure. Interest is shown is a revenue which is shown in the profit and loss account, not in balance sheet. Since balance sheet is prepared on 31st December at the closing date, so by that accrued interest becomes interest. So therefore, we give treatment when we buy come interest or we will buy X interest. Because whosoever made the investment, it is his right to receive the interest. If others are getting it, then they have to add to the cost of the investments. If you like this video, kindly like, share and subscribe it. Thank you very much.